Good afternoon, everyone. My name is Josh Ferruggio. I'm a relationship manager here on the Morningstar CPMS team. We're going to end this quarterly market review with a segment on environmental, social, and governance, ESG. Over the last few years, there's been a large focus on ESG strategies as our economy moves towards a more sustainable direction. Clients are demanding more from their portfolios, and investment professionals must be prepared. One of the main benefits of partnering with a global firm like Morningstar is having access to an abundance of resources. Last summer, Morningstar acquired Sustainalytics, a global leader in ESG ratings and research, offering data on 40,000 companies worldwide. This deal has benefited CPMS as we now have over 75 high-quality ESG variables directly fed from Sustainalytics. Today, we'll put one of those ESG variables in focus, the ESG overall risk rating. The ESG risk rating measures the company's exposure to material ESG issues and the management of them. The lower the company's ESG risk rating, the lower their overall risk of experiencing material financial impact due to ESG factors. Here you can see 82% of Q3's 50 best performing US stocks have a rating of less than 30. Taking a look at the Canadian 50 best stocks from Q3, 62% have an ESG risk rating of less than 30. Sustainalytics has created a single currency for both ESG risk and the management of their risk, allowing users to easily compare companies within and across industries. The Canadian market has a fair amount of resource companies who typically score poor on ESG risk, but let's look at an example of an oil and gas company that doesn't. Parex Resources. They rank 18 out of 256 in their industry group and score fairly well at 28.5. The rating is based on a two-dimensional materiality framework that measures a company's exposure to industry-specific material risks and how well a company is managing those risks. Parex could be exposed to health and safety risks within their operation, but their management team has responded well by implementing proper health and safety practices. Another example could be using artificial intelligence to reduce their carbon footprint by conducting analysis on oil producing potential. Due to the nature of their industry and business model, they are highly exposed to ESG risks. However, their company management has done a great job mitigating those risks through policies, programs, and practices. Taking a deeper dive, this is how Sustainalytics calculates Parex Resources' overall unmanaged risk. A company is provided an exposure score after analysis of their vulnerability or sensitivity to ESG risks. Only a certain amount of exposure can be managed. So in this case, 84.5%. Below that, you'll see managed risk. This is the score Sustainalytics has given Parex after analyzing their company's response, leaving us with a management gap, the difference between material ESG risk of the company and what they can be managing. After that, we are left with the unmanageable risk inherent to their products and services and the nature of their industry. This is the portion that can't be managed by the company, and it limits their maximum score at 18. We took a look at the US universe and grouped stocks based on their ESG risk category. Green, negligible and low risk. Yellow, medium risk. Red, high and severe risk. Looking at their average 90-day total return, negligible and low risk ESG stocks outperformed. Below that, we did the same grouping, but we used the average annualized standard deviation of the 90-day total return and found the green group had less risk as a measure of variation. The same story applies for the Canadian universe. Stocks that rank well from an overall ESG risk perspective outperformed and did so with less risk in the last 90 days. So when you're looking to build an ESG portfolio, lean on Morningstar CPMS. We can apply exclusions with negative screening. So this approach avoids investment in companies, industries, or sectors that may negatively affect the planet or its people. An example would be excluding fossil fuel or tobacco companies from a portfolio, or we can help limit ESG risk with ESG integration. And this approach considers industry-relevant ESG risks that could materially affect a company's value. An example would be evaluating carbon emissions for oil and gas companies. And finally, we can seek ESG opportunities with positive screening. This approach seeks to identify sustainability leaders or companies improving their ESG practices to build a competitive advantage. An example would be what we went through today, the ESG risk rating, investing in the highest rated ESG companies in an industry. So that concludes the ESG segment of this quarterly market review. Feel free to partner with your CPMS relationship manager to learn more about integrating ESG into your quant models. Thank you.